AI agents are everywhere, automating tasks and making decisions at machine speed. But agents make mistakes. Just one rogue agent can do big damage before you even notice. Rubrik Agent Cloud is the only platform that helps you monitor agents, set guardrails, and rewind mistakes, so you can unleash agents, not risk. Accelerate your AI transformation at Rubrik.com. That's RUBRIK.com.
We've talked on this show about how indexes do and don't work. Well, today, you're going to learn a little bit more.
If the Magnificent Seven were a country, its market cap would be second only to the United States. The market cap of the Magnificent Seven is now $20 trillion. That's more than the entire stock market in China. That's more than the sum of all European stock markets combined. That's 2.5 times the market cap of Japan.
That's Rob Arnott, the founding chairman of Research Affiliates, which recently launched a new cap-weighted index and a cap-weighted ETF to go with it. He's here discussing index construction and how if you build a better index and invest in it, you could get better results.
With conventional cap weighting, the more higher a stock's price is, the higher its weight in the index. Now, why would you want twice as much invested in a stock after it's doubled than before it doubled?
But up first, one of you questioned my math and what I'm teaching the kids when it comes to Halloween. Yes, we're going to do a second chance lottery for kids that want to go that route when they come to play cash or candy at my house. But does that second chance really give them double the chances of winning? I don't think so, and I'll give you the math to prove it. And as long as we're educating you on a bunch of other stuff, well, we've got Olivia Valdez, senior researcher for the FINRA Foundation here. And she's talking about what investors need to be educated on because half of them do not recognize the warning signs of fraud, according to some new research that FINRA just published.
All right, let's roll.
Rolling out indeed. This is Money Life for October the 29th. Thank you so much for joining me. Yeah, this is a show that, well, we're going to get a little wonky. We're going to get into some numbers. You may not like that, but it kind of is all keeping with that theme of the FINRA Foundation study that people don't recognize the signs of fraud. Well, you want to recognize the signs of a good index, whether you're doing this right, how much more you can make. That's the important questions that I'm asking Rob Arnott. And Rob is usually with us at the end of the year or the beginning of the year, talking about the year ahead. And we will have him back for that. We will break our house rules about how often someone comes back because we really just want to talk with him about the fact that they've developed this. And we've been having discussions on this show about index construction and what does it mean when you've got so much tied up in the biggest stocks. But what you're going to learn from him, and what I will point out to you in terms of listening for, we couldn't bring it out in the quotes because it wouldn't have really worked. It was too long, too wonky, is what's not in his index. And the story that you want to listen for is Palantir Technologies. Palantir was put into the S&P 500 at the end of September, so about a month ago. But it's not in the new Research Affiliates Index. And he talks about why that is. And that brings up a lot more on that point of, okay, are you buying something when it goes up and catching it when it goes down? He also makes a case with some other stuff. I do recognize this is a little bit wonky. That happens every now and again. But again, I'm asking you to tell me what you want to hear. And judging from some of the questions, well, I know you guys are looking to make yourself better investors. So the more you know, the better you're going to be. This is one of those. But let me know what you think. Chuck@moneylifeshow.com is how you reach me. Now, one of the people who reached out, Peter in Rhode Island, he's got the question where maybe he heard something wrong. Maybe I misstated what I was saying, but expected value is a big deal. Like all you need to know is that if I said, hey, we're going to have a bet on the outcome of a roll of the dice. So you have a 1 in 6 chance of winning. If I said the bet's going to be $1 and you could win $1, well, you'd recognize pretty quickly that that's a bad bet because you're going to lose it 5 times out of 6 and you're betting $1 to make $1. That's not a good wager, right? But if I said it's $25 if you win, well, then you have a 1 in 6 chance of winning, but your bet's only $1. So theoretically, you would win 1 out of 6 times. You would lose 5. You would win the 6th. You'd make $25. You would have bet 6 to make that 25. That would be a good bet. Now, the math, and we'll get into the math, and I know I don't like explaining math, but it's in there. But yeah, you should understand how lottery math works, how if you play a home poker game, like how do you calculate pot odds and when are you pot committed and all these other sorts of terms that people will use. But it's also how do you determine like good money, throwing good money after bad. You can use some of these same equations, not so much on trying to win something, but on when does it make sense for you to replace versus repair an appliance? When does it make sense for you to buy the next car instead of maybe replacing the one you've got? There are variations on the theme. You've heard me talk lots about Rich in Orchard Beach, Maryland. At the time when Rich died, he had this whole thing going on with his washing machine where he knew that they probably needed to replace it, but he was an engineer and he thought he could fix it. Well, if he could fix it, it was worth it for him to do it. But he also knew that if he had to bring in someone else to fix it, he should just go off and replace it. And that's because of the expected return on the money he was putting out, et cetera. Now, mind you, he could have afforded to do it. And when he passed, I actually shared a note with his wife that he had sent because she needed to replace the washing machine and he hadn't gotten it done. All this stuff comes into that. So don't just think about using the math here, use it every day. Check out MoneyLifeShow.com is how you reach me. I'm glad you're here. We've got great things planned. Let's get to it. Again, I'll answer the question first, then it's Olivia Valdez, then Rob Arnott. It's a great day to live the money life. At least I hope you'll feel that way when the talk starts next.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Welcome back to Money Life, where the scary part
is the math.
Yeah, the math does mess people up on this. We're doing a little follow-up because of a note I got regarding Halloween. And so, if you listened to the show the other day, I explained that I give away cash or candy every Halloween and that I do it in a way that is particularly fun. Kids from the 3rd grade and up, if they come to my house, they have a choice of a $1 bill or a full-size candy bar. The $1 bill worth $1. The full-size candy bar retail value $1.69. Or they can trade me a couple of pieces of candy for the chance to win an envelope where the average envelope is $1.70. Or they can trade me 5 pieces of candy for the chance to play the lottery, a $25 jackpot where you have a 1 in 25 chance of winning. So the average value for the envelope is $1. And what I said was that this year I'm adding a second chance where kids who play the lottery option, if they want to go again, can do that. They're going to pay another 5 pieces of candy. And now they'll be picking from a second set of envelopes where the maximum jackpot is $20. So the expected value is lower. I got this note from Peter in Rhode Island. He said, Chuck, for Halloween, make sure you aren't teaching kids the wrong math. If you give them a second chance, you are doubling their chance of winning, not reducing it. Peter, I am not making fun of you when I say you come from Rhode Island, the state which, along with Massachusetts, where I live, have the highest number of scratch tickets played and the highest lottery spending per capita in the country. Lottery math confuses a lot of people, which is why you get both sides of the coin. Your side of the coin would be this one.
The lottery is the one ray of hope in my otherwise unbearable life.
My take on the lottery generally would be this one.
The lottery. Exploiter of the poor and ignorant.
Yes, they get a second chance to win. But what I hope I said, I did not go back and listen to it, is that their expected value is worse. Now, expected value of a bet is the probability of winning times the winning amount minus the probability of losing times the losing amount. I know that's wonky, but we can do this. And this is how you go out, and when the lottery jackpot gets large enough, Charles Rotblut from AAII has joined me multiple times saying, yep, we're now at that spot where the expected value of a lottery ticket is greater than what you're paying for it. That doesn't mean it's a good bet. That just means that, oh, by the way, you're not a likely loser. So let's run this math just very quickly. So the expected value, it's the probability of winning. Well, they have a 1 in 25 chance of winning, so it's 1 divided by 25. So 1 divided by 25, if you want to keep score at home, is 0.004. And then they could win $25. So 0.04 times 25 equals 1, right? Then you take away the probability of losing. Well, they have a 24 in 25 chance of losing. That is a 0.96% chance of losing. And what they are losing, technically, it's the dollar that they could have gotten for coming to my house, exclusive of the candy that they are paying to play the lottery. If you had just the dollar, if it was straight up, I could get $1 or I could play the lottery for the chance to win 25, then you get that 1 on the first half of the equation minus 0.96 and you get 0.04. And if you took the bet every time, you'd expect to make 4 cents per bet. That's the average winning, right? Because it's $25, et cetera. You can fool around with payouts and everything else. But if we factor the value of the candy in, now we're saying you've got the dollar that you're giving up for coming to the house and let's say $1 worth of candy to keep the math simple. Now you have that 24 divided by 25, the second half of the equation being 0.96. You're multiplying it by 2 and you get 1.92, which means you're taking 1, the first half of the equation, the probability of winning times the winning amount, minus the second half of the equation, the probability of losing and the losing amount, and you come out with a negative 92, which means that basically if you do this long enough, every time you make the bet, you're expecting to lose 92 cents. Again, if you consider the cost of candy free for everybody else and just made it $1, then the fact is this would turn out positively for you. You would wind up, again, making 4 cents would be your average. But you could have $1. That's why we're doing it. But now remember that on the second chance, you're not doubling your chances of winning because it's a completely separate drawing. So it's still a 1 in 25 chance, but now your jackpot is only $20. So again, that equation, probability of winning, still 0.04, 1/25. The winning amount now $20. That means the total on the left side of this equation is 0.8. Remember, it was 1 the first time. So now you know where the expected value of the first bet was 4 cents. The expected value of this bet is going to be negative. And you can kind of follow out that math and recognize that you're going to lose an average of 16 cents on the bet. And again, if you factor the value of candy in, it gets greater. Lottery math confuses people a lot of the time. They want to make it that your odds of winning go up. But realistically, it's your chances of winning. If you buy more tickets, you have more chances to win. But each ticket is its own proposition. And yes, it does take one more out of the set of entries if that set of entries is limited. So what you don't know when you're buying a lottery ticket is how many people pick the same numbers, right? They always tell you if you're going to pick your numbers, pick them high and do the things that a lot of people don't do because everybody's picking the single digits and the things under 30 because they can use birthdays and anniversaries and all that other sort of stuff. Well, that means that if you were looking at your expected value, you might think, wow, if I pick everything under 31 so that I can use calendar dates, somebody else is going to do the same thing, and therefore my winning amount might be cut in half. Therefore, my expected value could be less. You can't factor everything in on a lot of lotteries. You can on this one. So we're not going to get into all this with the kids. We just try to let them know that, look, you came in, you could have had $1. You traded that $1, and then you traded some candy on top of it. And yes, candy is a very cheap currency on Halloween. But frankly, I'm hoping that they can understand the idea of like, this was a bad bet. And then the bet got worse if they decided to follow up. Now, look, most of them would tell you that they're not giving up $1. Here's the flip side of that value and how they can make this choice and not be making a bad choice. it's really not their money. They're playing with house money. So we don't want the equation to go to zero because it messes things up. But even if you did make it zero, well, then the expected value of your bet, if you said, again, the probability of winning times the winning amount, 1/25 times $25, that equals 1 minus the probability of losing times the losing amount. If you think you're losing nothing, well, then your expected value is the same dollar. So you could say it's the same, but I know this messes things up, but this is how you want to be looking in terms of what your thinking is, Peter. This is what you want to be looking at. You want to be looking at what that expected value is. Yes, they could look at it and go, well, my expected value is $1, and then I'm hoping to win more. They could make that choice. But these will be the only lottery tickets that they, quote unquote, pay for without paying with something that has value to them. And having done this many times, I can tell you that it always seems like a great idea. Yes, play for the big money. And then they lose and they're like, oh, I shouldn't have played for the big money. And that's a huge part of the lesson that we're trying to teach them. But I hope that they have questions like this. I certainly do, because that's part of the fun of what I do on Halloween. Again, if you want to know more about it, go back and listen to last Friday's show where I talked about it, and don't be shy about asking questions. I will say that I'll come back after Halloween and let you know how it all turned out. But thanks for the question. For anybody else who's got questions, wants follow-up, etc., Chuck at MoneyLifeShow.com is how you reach me. I'd love to hear from you. Up next, talking about what the survey said, and then Rob Arnott from Research Affiliates. Stick around, because I know you'd love to hear from them, too.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Now Money Life looks at what the survey said. Yes, welcome to The Survey Said on Money Life. This is where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are looking at the National Financial Capability Study done by FINRA. The FINRA Foundation takes a look each year, and I both love and hate the details and the data here because, frankly, the headline number is that half of investors don't recognize the warning signs of fraud. So I love it because we need to talk about it because plenty of smart people are being victimized by frauds. And I hate it because, half of investors do not recognize the warning signs of fraud. Here to discuss it, Olivia Valdez. She's senior researcher at the FINRA Foundation. It's finra.org for the organization. We have a direct link to the financial capability study if you go and find Olivia in our show notes or on our guest page at MoneyLifeShow.com. Olivia Valdez, welcome to Money Life.
Thank you. It's so nice to be here.
Let's try to set everybody up for what is missing, because when we talk about not being able to recognize the warning signs of fraud, well, help by first defining what are the warning signs of fraud that you guys believe every investor pretty much should know.
Yeah, so there really are a couple of different warning signs of fraud. There's some classic ones. We asked a question that was specifically like, would you be interested in investing in, this opportunity? And the opportunity involved a promise of a guaranteed risk-free 25% annual return for the next 5 years. So in that, there's two hallmarks of fraud. Number one is that something is guaranteed risk-free. We know that there is no such thing as a risk-free investment. So that should be something that tips people off that might be a fraudulent opportunity. And then the other thing is this 25% annual return for the next 5 years. So consistent, very high returns, also very unlikely, another hallmark of fraud.
Is the financial services industry making this somewhat harder on the individual investor? Because the lizard brains of investors want things that are guaranteed. They want things that are low risk. But when we talk risk-free, consumers don't really understand that term. They think they do, but I find that investors frequently don't really understand risk. They think that the only risk is the risk of losing money. So we're getting a lot of products right now that, oh, we'll put an insurance wrapper on a thing and you're guaranteed not to lose money. You're giving up upside, but you're not getting whatever. And those products are legitimate, but they do play to the idea that, hey, there's things out there that you can buy that are basically risk-free, that are not treasury bonds. So is the industry making it harder for consumers to sort through what's real and what's not?
So we can't really speak to the extent that the industry is making this harder. What I can say is that there's a lot of language that we see used in marketing that is similar to the kind of language that we see in fraudulent pitches. So it becomes difficult for consumers to identify, what's real, what's not. The definition of risk is something that we do see people struggle with. And just like you say, people understand risk as if I lose money, it's risky. If I don't, then it's not risky. And so there are some challenges with understanding what is risk and investing knowledge that come into play here. So understanding that every investment can lose money. There is no such thing as risk free is something that's really important for investors to understand.
The obvious separator for who falls for the bad stuff and doesn't is some measure of investing knowledge. How knowledgeable do we feel investors are? Like, I'd love to know sort of what was that break point where we go, these people knew just enough. I know some of it comes with age, but with age also becomes I'm a little less likely to take that, to be lured in by the 25% annualized gain unless I'm way behind. But is there a basic standard that we understand? Oh, once they do this, or once they've got this going on, they have kind of passed the knowledge hurdle and they're okay?
So that's a really hard question. We don't have that per se, but in our data, we do have a battery of questions about investing. So we ask people knowledge about stocks and bonds, about inflation affecting investments, all of these different kinds of knowledge questions that we know that are fundamental. It's hard to say, like, what is the threshold of knowledge that is enough versus not enough, but we do try to assess people's investing knowledge. And what I can say is we have these 11 questions. We label high investing knowledge as at least 8 out of 10 of those questions correct, versus low investing knowledge, we label that as you only answer 3 or fewer of those questions correct. When we break it out that way, we see that investing knowledge does matter. So folks or investors that have high levels of investing knowledge, based on our definition here, only 36% are saying that they're interested in this, what seems to be a fraudulent opportunity, versus much, much higher for those with low investing knowledge.
And what we can't tell, I assume from that, is also of that 36% of knowledgeable investors saying, I might be interested in this opportunity, is, if you threw it in front of me, well, I could be interested, but I would also know how to vet it out and go, okay, this is actually a fraud, or, wow, this convinced me. So we also don't know what percentage of them are interested, because if it was real, it would be good and they can sort it out, right?
Right. And that's a really good insight that we have tackled, because, there is an extent of we don't know what people are thinking when they answer this survey question. So, there's always opportunity to do some focus groups to ask people, what were you thinking when you answered this question? But yeah, that there's certainly a portion of the population that we assess that could be thinking like, well, if the threshold of you asking me this question is that I know that this is a real opportunity, then that's how I'm answering. But just the definition, the fact that these have the hallmarks of financial fraud, there is no such thing as a risk-free investment opportunity. That should be a huge red flag, regardless of what more information you want to know.
Well, the other thing that struck me as a red flag when I was reading through the data, that apparently does not strike a lot of investors as a red flag, is who's getting paid for this? What's the endorsement? And social media, nearly 3/4 of the respondents, if I read this right, nearly 3/4 of the respondents said, oh, if my favorite TikTok personality or what have you is talking about a financial product, I'm a heck of a lot more interested, right?
Yeah, we're seeing that a lot of investors who rely on social media personalities, who use social media in general, are much more likely to say yes to, or, to say yes to this hypothetical opportunity.
And when it comes to things that investors in many cases don't understand, like crypto, right, et cetera, is that also a place where even the experienced investors are kind of going off the reservation because, okay, I'm in that percentage that maybe should know better, but the questions that I'm getting wrong are maybe the crypto questions. Like, did we find that the newfangled stuff, maybe the more experienced older investors who did better on this in terms of financial capability, that's where they stumble because they hear so much talked about it, but they don't fully get it?
That's a really good question. So we haven't divided completely by product and by age. We do see that just in terms of who's investing in which products, those who are invested in these investments that arguably could carry higher risk, things like crypto or, who trade meme stocks, we do see that those folks, they are much more likely to say yes to this. So there might be some overlap there as well.
Yeah, if you take risk in one area, you're more likely to look for it accepted in another. But the question is, are you taking risk capably? And the financial capability study says not everybody is. Olivia Valdez, really interesting. Thanks for joining me on the show to talk about it.
Thank you.
That's Olivia Valdez, senior researcher at the FINRA Foundation. And while if you are a Money Life listener, we'd love to believe you are fully financially capable, maybe you want to take a look at what the questions were and see for yourself. You can do it by going to finrafoundation.org. And then there's the direct link in our show notes or on our guest page where you find Olivia Valdez. And one thing I know you are capable of is getting more money talk today. So we'll take a quick break, and there's a 100% chance that Money Life will be right back after this message.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Welcome to the big interview on the October 29th edition of Money Life. Returning to the show right now, Rob Arnott. He is founder and chairman of Research Affiliates. And if you want to learn more, researchaffiliates.com. Rob and I normally talk once a year, right around the turn of the year, as we get his outlook, his take at what's been happening in the year. And we're still going to have that conversation. But if you've been listening to Money Life for any length of time, you almost certainly have heard me talk about how index construction at times kind of makes me crazy because, well, if you were going to create the way we follow the market today, you probably wouldn't do it based on the S&P 500 methodology. You certainly wouldn't do it based on the Dow Jones methodology, et cetera. Well, Research Affiliates recently announced that it was creating the Research Affiliates cap-weighted US ETF based on their Research Affiliates cap-weighted index, which is a different approach to cap-weighted indexing. So we're going to talk about how all this stuff works. But like I said, if you want to dig in more for yourself, researchaffiliates.com. Rob Arnott, welcome back to Money Life.
Thank you so much. Privilege being here.
I don't want to get bogged down in the wonky stuff because you and I would have fun talking about a lot of stuff on how you reimagine the index. But I want you to start with the problem that you felt needed to be solved here, because I've talked about it in many different ways. But as I've explained to my audience, if you can look and say, hey, there's only like 21 large cap growth stocks or what have you, or this many stocks control this much of the index, and General Motors is now a mid-cap stock, you're living in times where traditional measures haven't worked. So
yes,
what is the problem you wanted to solve for before we get to what the solution is?
Sure. Well, there's two big problems with conventional indexing. The first one we already addressed with Rafi when we introduced the fundamental index back in 2004 and 5. With conventional cap weighting, the more higher a stock's price is, the higher its weight in the index. Now, why would you want twice as much invested in a stock after it's doubled than before it doubled? Wouldn't it be lovely to do the opposite? But in point of fact, with cap weighting, the more expensive a stock is, the bigger its weight in the index. All right. Indexers have been aware of that criticism since the dawn of indexing, and they brush it off with a very simple and very direct observation. Unless you can tell me which stocks are overpriced and which stocks are underpriced, you haven't said anything useful. And that's true as far as it goes. Jack Trainer, one of the co-originators of the capital asset pricing model, wrote a paper back in 2005, Why Valuation Indifferent Indexes Add Value. Valuation indifferent indexes means you're not tying the weight to the price. The weight is independent of the price. Well, you could do that with equal weighting. You could do that with a minimum variance strategy. You could do that with fundamental index. Fundamental index ties the weight to the size of the business. And so you're not, if the price doubles and the fundamentals don't validate that, you're going to say thanks and you're going to chop the weight in half. Makes sense. Makes total sense. It does create a value tilt. So one of the things that, circling back to the second big problem of indexes are perceived as passive. And for the most part, they are. They're just along for the ride. But every index has turnover, typically anywhere from 3 to 10%. Let's call it 5. 5% turnover means an index is 95% passive. Doesn't care whether the stocks are up, down, or sideways, doesn't care if the underlying business is flourishing or floundering, doesn't care, just along for the ride. The 5% active slice is problematical because it's not at all neutral. It's not at all market-like. You're buying frothy growth stocks at premium multiples, and you're dropping unloved deep value stocks at deep discounts. So that second problem is also fixed by RAFI because RAFI doesn't choose stocks based on price or recent price movement. It chooses stocks based on the fundamental size of the business. But we realized that if you want a market index, a passive index, you have to be cap weighted because the market is cap weighted. So if you want to track the market, you need a cap weighted index. But you don't have to buy frothy growth stocks, emerging growth stocks, and you don't have to dump deep value stocks. You can behave in a more moderate way. We did studies back in 2018, a paper, Buy High and Sell Low with Index Funds, in which we showed that the average stock that's added to an index is at twice the market multiple and will have risen by about 75% in the year before it's added. And the average stock that's dropped is at half the market multiple and has underperformed by 3,000 to 4,000 basis points in the year before they're dropped. So you underperform by 3,000 or 4,000 basis points. You participate in that as an index fund owner, and then you kick the stock out. You outperform by 7,500 basis points. You don't participate as an index fund investor. It's not in the index yet, and yet you then add it because it soared. That causality is troubling. It's deeply disturbing. So we developed Research Affiliates Cap Weighted Index back in 2021, quietly. We created the index. We posted it on Bloomberg so that once there was tangible evidence that it was not just a back test, but was working live in real time, that we could then roll it out as an exciting new concept.
But before you go further, let's try to make sure that we're giving some people some numbers of why this stuff works or why this stuff matters. What you're talking about, that 5% at the bottom that gets kicked off or what have you and gets replaced, how much distortion does that add? So having created a new index, and again, trying to solve a problem that the original index that you guys made didn't back in 2004. So 20 years later, how much distortion does this create? Because that's part of what the consumer wants to know. It's like, okay, we understand there might be some, but help us understand the scope of that problem.
Sure. When we introduced RAFI, one of the things we did was return attribution, looking back over the prior 30, 40, 50 years and asking, how well does this perform? How consistently does it perform? And where does the performance come from? And what we found was that RAFI outperformed the market by about 2% a year, of which about 3/4 of it was the dynamic contra trading against the market's speculations. The market's constantly changing its mind as to what a stock is worth. And if it's not validated by the underlying fundamentals, we're going to contra trade against that. And that's 1.5% value add. The other 0.5% was from stock selection, which I remember thinking at the time, that's weird. We're not doing stock selection. Well, we're choosing the companies that are biggest, but we're not picking stocks in any conventional way. But the cap weighted indexes choose stocks based on market cap. If the market cap is big enough, it's interesting, it's included. If it's not big enough, it's not interesting, it's not included. We look at this fundamental size of the business. If it's a big enough business, we include it, doesn't matter the price. And if it's a small enough business, we exclude it, doesn't matter the price. And so RAFI, we realized, adds value partly by changing the paradigm of how you choose stocks to add or drop. 0.5% doesn't sound like a lot. In an index fund world where people squabble over a basis point of fee, 50 basis points is a lot. In fact, RACWI US, if you go back over the last 35 years, and that's a reasonably long span, over the last 35 years, you would have added over 60 basis points a year relative to S&P 500. Now, that's with 90 to 95% overlap between the two. The difference between the two is tiny. The holdings are cap weighted in both cases. So if you have 400 names overlap, including most of the big names, and 90 to 95% of the weight of the index is overlapping holdings, those holdings are going to be the same. And so the 5 to 10% difference in holdings is driving 60 basis points of incremental performance. If you've got 5% creating 60 basis points, that means that 5% that we have and S&P doesn't is beating the 5% that S&P has and we don't by 12% per year. That is huge. One of the things that I think is just fascinating is, why hasn't anyone noticed this before? We've focused a lot of attention in the last 10 years on additions and deletions, and the market pays shockingly little attention to that. It hasn't been noticed for two reasons. Firstly, index funds are perceived as passive. The active slice is just that little 5% turnover. Now, that active slice is wild. I like to joke that the active part of indexing looks like Cathie Wood on crystal meth. Not that, I mean, she's very conservative and very proper and appropriate woman, and imagining her on crystal meth is a little bit of a stretch. But if she was on crystal meth, she would behave like the active managers at the fringe of indexing. Now, that 5% is the source of our value add. People don't notice it because the turnover is small, and so they think it doesn't matter. They don't notice it because the index is its own benchmark. If it's its own benchmark, if the S&P was benchmarked against RACWI, it would show up as, oh, this active strategy, S&P 500, and it's an active strategy because there's a committee that chooses what to buy and sell. So this active strategy is lagging this perfectly sensible index by 60 basis points a year and underperforming in roughly 3 out of every 4 years. Wow, why are we wasting time with this? And so we introduced the index 4 years ago, and we're rolling it out as a live strategy. ETF Architect launched an ETF in September. It's still tiny, but it's already ahead of the Spider. It's already ahead of VU.
Well, and it's by the way, ticker symbol RAUS is the research affiliate's cap weighted US ETF. There are going to be people who don't understand what we're talking about here from a different perspective, which is all the talk about the index has been the Magnificent Seven, and what a big chunk of the index has been because of that. And as you point out, 95% of the indexes here that we're talking about overlap. So how big a problem is that kind of outperformance by a few stocks for the index. If at the flip side of that, 5% of the index, which is more than the same number of stocks because we're talking little stocks and what have you. But on the one hand, as you point out, it seems de minimis, but obviously there's a big deal. What does it also say for us for index construction then when we have those 5 that are skewing so many things, or the 7s rather skewing so many things?
We own the 7. The Magnificent 7 are big companies. They're big market cap, but they're also big businesses. And so they qualify for RACWI US. And they're just as big in our index as they are in the S&P. In fact, they're a tiny, tiny bit bigger. Here's why. The companies that are in the S&P and not in our index are little companies trading at lofty multiples. The 3 biggest of those would be Palantir, CrowdStrike, and DoorDash. Now, Palantir's big company with huge publicity. No, it's not a big company. Sales last year were, I forget the exact number, $2 to $3 billion. That's sales. Profits were de minimis. And trading at $300 to $400 billion. You're trading at over 100 times sales. Now, that's extraordinary. It's a small business trading as a big market cap stock, and we leave it out. The 5% that we leave out is replaced with our companies, which are big businesses trading at deep discounts. All right, so that creates a little bit of a value bias, but they're small cap. And because they're small cap, that's 2%. So we're dropping 5% of the S&P. We're adding 2% of new names. What do we do about the other 3? We take the overlap stocks and we bump them up by 3%. So if NVIDIA is 7% of the S&P, it'll be 7.1% of our index. Just a tiny little nudge up. So we're actually overweight the Magnificent 7, but don't include at all little companies trading at super frothy multiples. And so that kind of is an anti-growth bias on the frothy little companies, offset by a little bit of a growth bias at the top of the list where we lightly overweight them. So a lot of nuances to this. Fun stuff.
Yes, but I think a lot of people would be surprised that a name like Palantir Technologies, which became part of the S&P 500
Yes,
just recently, end of September, if I recall correctly, is not in your index and presumably not coming in until it has sales, until that multiple is, or some other metric is changed.
Yeah, and the beauty of RACWI is it picks stocks for the right reason. You're buying companies because they're big enough to matter. You aren't buying companies because the price has soared and it's all of a sudden being added because it's embarrassing it's not in the index. And this other company is deleted because it's cratered and it's embarrassing that it's still in the index. No, we sit back, we're more patient and more measured. And for every NVIDIA where we're slow to add it, we're also not going to get a Rivian or a Pets.com where we're adding it for reasons that blow up, that disappear because the company never lives up to expectations. So for every NVIDIA where we're a little slow on the uptake, there's going to be several Rivians that, thank goodness, we don't buy because those are flip-flops. They're bought high, they fail to live up to expectations, they crater, and then they're dropped at a much lower price. Flip-flops are the bane of index fund management. And I've got a working paper, CFA Institute, their research foundation asked me to write a paper on the active side of indexing. And it's in late stages of drafting. It'll probably come out early next year. But part of the focus is flip-flops, mistakes, companies that are added because they've soared and that don't live up to expectations. And a little less common, deletions, deleted from the index because they've cratered, that turn out to regain their footing and get added back in the index.
But again, only get added back after they've reperformed.
Right.
So the investors missed out on being the value investor and doing the right things. One of the criticisms of the indexes has been that, the S&P 500, when it started, was basically a large cap index. Now it's a lot more of a mid cap-ish kind of index because of the way things have skewed.
It's the concentration issue. It's the valuation of the stocks at the top of the index. We've done a little paper looking at the Magnificent Seven. And if the Magnificent Seven were a country, its market cap would be second only to the United States. The market cap of the Magnificent Seven is now $20 trillion. That's more than the entire stock market in China. That's more than the sum of all European stock markets combined. That's 2.5 times the market cap of Japan. Now, think about it in these terms. The market cap of a stock is supposed to be the market's best estimate of how much in future profits is this company going to give to the shareholders in the decades ahead, discounted back to today, discounted net present value. So 20 trillion is a big number. It also says that these 7 companies are going to deliver more profits to their shareholders than all Chinese companies combined or than all European companies combined. That seems to me to be a big stretch. Is it possible? Yes. Is it likely? I think not. It's a very aggressive assumption. What could possibly go wrong? Well, a lot of things. One is simple competition. If you take the 10 most valuable tech stocks in the world in 2000, top of the dot-com bubble, what you find is that 0 out of 10 beat the S&P over the next 15 years. Not one. People will say, what about Microsoft? Microsoft, you had to wait 18 years to be ahead of the S&P. 18 years. People will say, what about Apple? What about Amazon? Apple was ranked 37th in the world among tech stocks because it was thought to be at risk of bankruptcy in 2000. Amazon was Amazon.bomb. How can a bookseller be worth this much? The decade of the 2000s, it was regaining its footing and diversifying and creating new markets. It's the decade of the 2010s that it exploded upward. And so Amazon was ranked, I think, 26th among world tech stocks. So the 10 largest market cap tech stocks, you had to wait 18 years to get one of them ahead of the S&P. And today, 8 of the 10 either have ceased to exist or are far behind the S&P, or even have a negative cumulative return for a quarter century.
Well, that's what I always remind people when they talk about, the computer boom as they're going to the AI, is if you went back to the 1980s, you would have thought Wang Labs and Prime Computer and all those others were going to be the winners. And Microsoft and Apple, they were not even in the conversation.
Digital equipment, for sure. I mean, digital equipment was creating real computers for less than 25 grand.
Exactly. And now we laugh about all of those things and the mistakes people made. I want to ask, in limited time, 2 other index questions. One of them is one of my favorites, and it comes from the fact that 30 years ago this week, I heard what I consider the best investment speech I've ever heard with the best market forecast ever. I had organized the Society of American Business Editors and Writers Conference on Personal Finance, which was held here in Boston. Our original keynote speaker was going to be Jack Bogle, and 2 weeks beforehand, Jack had to cancel because he was not in good health. He was awaiting his heart transplant, and he had been told, you cannot travel, you're on the list. And he actually had the heart transplant before he would have given the speech. He came and spoke a year later. In his stead, we got a guy named Bill Berger, who you may remember. He kind of looked like Santa Claus. He ran the Berger funds. And Bill came and he brought out a story with him from the Weekly World News, because the internet didn't exist in those days, but he had a reader who went and found him interesting stories. And his reader had found him a story from the Weekly World News about tell your future in your next pizza. And it was a guy ruminating over a pizza. And he basically made a point. He said, forecasts, most people don't try them. They're about as reliable as trying to do this with your next pizza. But if you want a forecast, I'm going to give you one. And the number he said then was Dow 116,200. So Dow 116,200. This was before Dow 36,000 had been done by Kevin Hassett and James Glassman or anything else. And his logic was, He had been in the investment world for 45 years. And at the time he had started, it had been Dow about 250. At the time we were talking, Dow was in record territory at about 4,500. And 250 to 4,500 was the same over 45 years as 4,500 to 116,200 by 2040. That's what it meant. We'd have to get there. So now we are 30 years, 2/3 of the way there. We are at record levels roughly on the Dow. And oh, by the way, we only need about 7% over the next 15 years to get to Dow 116,200. So the greatest potentially investment call of all time still sounds ridiculous to most people on the face of it. But given the way indexes work, is he going to be right?
I think it's a little bit of a stretch, but he's in the ballpark. I say a little bit of a stretch because valuations in the US are high. Now, the Dow doesn't have a whole lot of the Mag 7 companies, obviously. So Dow isn't as frothy as the S&P or Russell Index. But our outlook for S&P 500 on a 10-year basis, which is not 2040, it's 2035, is 3.5% a year, of which one is yield. So 2.5. You need 7. Could it happen? Absolutely. Is it likely to happen? I think it's going to fall short, but I think it'll fall short by a small enough margin that it'll still be the greatest forecast in history.
Okay, I like to hear that. It'll be interesting to see how it plays out. Now, my other question. You have spent all this time working on indexes. I'm now going to go back even further because in 1988, I became the business editor at the Morning Call in Allentown, Pennsylvania. It was right after 87, the market crash and everything else. I had my cat named Millie Schembeckler, named for the wife of Michigan's football coach, pick stocks. She did it by walking on. Every morning she would interrupt me as I spread the newspaper out. She'd sit down, her feet and nose, because that's what people used in those days. If you walked into the broker's office and the advice smelled good, you took it. And we created the Millie Index, which was everything she picked for the month of September. And we created it two ways, one of which was equal weighted, which no one thought about back in those days. Not that I'm looking for credit, but nobody thought about it. The fact is, she killed the market over the year or so that we tracked it. Today, there'd be ETFs based on her work, et cetera. But we're also at a point now where everybody's doing individual indexing. When I wrote about that at one point for the Wall Street Journal, everybody in the industry told me I was stupid. It's never going to happen, et cetera. As the guy who's doing indexing and watching indexing and spending this much time on an index that we just went down the rabbit hole on all the esoteric things, or all of the individual indexes that you hear about, roughly the equivalent of my cat picking stocks, or how valuable are they?
If you're talking cap-weighted indexes, it's very similar to your cat picking stocks and cap-weighting them. A random selection cap-weighted should roughly match the performance of the broad market on average. Your cat will win over most indexes. Your cat will win for the simple reason that indexes weight stocks based on how expensive they are. The more expensive they are, the bigger the weight. And stocks choose stocks to add to the index based on, has this stock soared enough that we really are embarrassed it's not in the index? So let's add it after missing that huge run-up. There's a company, Dillard's, a department store, that has been a member of the Russell 1000 index 5 times this century to date. 5 times. So that means it's been kicked out 4 times and it's been re-added 4 times. Every time it was added, it rose an average of 75% in the year before it was added. Then it fell 70% before it was kicked out again. This is all relative to the market. All right, you missed the up 70, you got the down 75. Ouch! You're not back where you started. Net, you're down over 50, and you didn't enjoy the upside. Every time it's dropped, it underperformed by an average of about 40%, and then it outperformed by an average of 200% before it got re-added. Again, this is relative to the market. It's tripling relative to the market. So here's the fun factoid. If you owned Dillard's while it was a member of the Russell 1000 this century to date, you would today have just over 1/100th as much money as if you'd left it in the Russell Index Fund. You would have lost 99% of your money relative to the market. If you owned it during the years when it wasn't in the Russell 1000, you would have over 40 times 40 times as much money as if you were in the Russell 1000. Now, that means a 4,000 to 1 wealth difference between owning it when it's not in the index and owning it when it's in the index. Wow. And that's just a function not of the stock being incredibly schizophrenic, but of the stock just happening to have crossed the threshold to get added and dropped 8 times. Each time costs you about 1/3 of your wealth that's tied up in the stock or that's not tied up in the stock.
Yeah, that cat's gone. She died many, many years ago. But my
Bring her
dog,
back.
what you're suggesting is my dog, who doesn't necessarily have much of an attention span, he might be good at this. Rob, it is always great to chat with you. I very much appreciate the perspective. We will talk again in the not too distant future as we get your outlook for the year ahead and more. Thanks for joining me.
Thank you for your time.
That's Rob Arnott. He is founding chairman at Research Affiliates. It is researchaffiliates.com if you're looking for more information. And if you're looking for more of Money Life, well, we've got just a little more to go on today's show. We'll be right back to do that after this message.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
We are back to wrap things up. I hope you enjoyed that interview with Rob Arnott. I will point out, we have house rules about how often someone can be back on. At first, we're going to do this as an other interview. Obviously, I let it run very long. That's about as long an interview as we will do here on the show. But we will have Rob back because I didn't talk to him about what he's seeing happening on the markets right now, other than as it applied to the index. But I want to point out that after I finished the interview, when I was getting around to some of the reading I was doing last night, am behind because I haven't been feeling all that good. I got around to reading something that Christine Benz from Morningstar wrote. I'm going to try to get her on the show to talk about it, but I want you to know about it so you can go look. Christine Benz from Morningstar was speaking at the Bogleheads conference, folks who index the old-fashioned way because they're Jack Bogle believers. And she writes a piece that you can find at morningstar.com on, and I'm quoting here so you can do a search, the case for a good enough portfolio. She puts good enough in quotes. But again, Christine Benz, Morningstar, good enough portfolio. You'll probably find it right away because it just came out. If you think about the effort that it takes, if you've got a great portfolio, Rob Arnott's right. You could squeeze more out of it potentially by doing the stuff he's talking about. You could find a better way to index. But would you want to overhaul everything you do? Would you want to take more chances or make yourself have to work harder? And that's a question that, you have to decide, is the juice worth the squeeze? If you have a portfolio that you like and they said you could do better, but you're doing incrementally better, but to do better, you're either going to have to go through a lot of work, a lot of research, a lot of monitoring, whatever it might be, then is it worth that? And do you want to do that forever or for as long as you're going to be doing it? And what happens if you get to where you don't want to do it and you become lazier? I think those are questions that also have to be asked. Like you can say, this is the best methodology. But that doesn't mean you can live with it. And I think that applies to a lot of things in the investment world. Hey, what applies to Money Life is that we have great guests every day. And tomorrow on this show, Brian Whalen, Chief Investment Officer, Head of Fixed Income at TCW, makes his debut on the show. So does Arnold Groninger. He's the founder of Low Groninger Partners. He is a value investor. He's going to do the market call. And then we're going to talk about his book, which came out not tomorrow, but later. We'll talk about his book, The Perceptive Investor, The Art, Science, and Temperament of Successful Value Investing. His book's been a little long for us to be doing a book interview, but we will do one nonetheless. So it's worth it because you'll get to kind of piece both sides of it together. But we're going to do the market call first, and then if you like it, you'll get more with that follow-up from the book. So that's coming tomorrow, along, of course, with Todd Rosenbluth from Vetify with the ETF of the week. So make sure you're here. We've got more great things coming. I'll tell you about them another time. Meanwhile, if you're looking for something to celebrate today, it's World Stroke Day. Please worry about stroke health. Learn the signs It's super important for helping you get recovery and fast treatment. It is National Hermit Day, which is not about hermit crabs. It's about hermits, like, people who are hermits. It is National Cat Day, which I know my daughter Thompson will be celebrating with her 2 cats, Hallie and Sassy. And it's National Oatmeal Day. My guests today were Olivia Valdez, senior researcher at the FINRA Foundation, which is online at finra.org. And then, of course, Rob Arnott from Research Affiliates, researchaffiliates.com. By the way, again, the Research Affiliates cap-weighted U.S. ETF, the new ETF we were discussing, is RAUS. That's the one that follows the RACWI, the Research Affiliates cap-weighted index. Thanks to them. Thanks to Rob Floyd, my producer. Thanks, of course, to Maho, my dog. But mostly, thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Stephen King, who said, "We make up horrors to help us cope with the real ones." Well, I hope your real ones are not so real that you can't move forward. And I hope you're keeping everything in perspective that way when it comes to your financial horrors. And with that, I hope you'll remember each and every day that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again on Money Life tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Another day, another nickel.